Bloomberg Audio Studios. Podcasts, radio, news.
Let's dive in to one that is showing stronger user growth, down 1.6%. I'm talking about DraftKings. We're looking at Jason Robins, the CEO now, who managed to deliver what was record second quarter performance. Your revenue up 37% year on year, and you're talking about delivering revenue closer to the high end of 2025 for the full year. So what's the investor digestion going on, do you think?
Well, I think right now we have a ton of momentum in the business. We also had some, good luck on the sport outcomes side in Q2, so that was nice. And we're geared up for what is the most important time of year coming up with NFL, and then obviously college sports, NBA, World Series, NHL, just a big, big time of year. It's when we make our most revenue and acquire our most customers and make our most adjusted EBITDA. So really excited for that. And I think we have some great plans in place and, really expecting strong growth in the back part of the year.
I mean, your shares are up 20% year to date, so it might be why we come off a little bit from our highs overall. But what about the core value drivers here? Like, we're talking about, the sports book-friendly outcomes. You talk about how the calendar is looking good for you. But where else do you focus on investing? Because your CFO in particular, Alan, talking about some growth initiatives, and everyone's wondering about these prediction markets that might or might not come to bear.
Well, even if you adjust for the outcomes, we were still up 25% revenue-wise year over year, so really healthy growth. And I think we're seeing, just very strong demand in our underlying customer cohorts. And I also think the advancements we've made on the product side have been huge. We've really built out our parlay offering now. We have the best-in-class and leading offering when it comes to in-game betting. That's become the real growth driver of the industry right now, by far. More growth happening in live betting than anywhere else. So I think really we positioned ourselves well from a product and customer experience perspective. Our marketing has been very effective. I also think on the internal side, we've gained a ton of efficiency through use of AI, which means we're getting more done for the customer and also saving money.
Okay, like what? How are you managing to interject generative AI across the board?
I mean, the simple thing that we've been able to do is get everyone in the company to realize that they can drive value, and it doesn't have to be the engineering team doing everything. So much of, tooling right now through AI can be used by non-engineers, and everyone throughout the company knows that there's tons of manual workflows that can be automated through AI, and we've been on a tear doing that. We've also been working on select projects that are customer-facing too, things like optimizing our trading engine, because a human can't possibly take in all of the data and all of the things happening at the same time when a live game is going on. So having AI agents support that and help make lower level decisions, I think, is also a huge unlock that we're pursuing. So I think the best is yet to come as far as AI, and we've got a ton of organizational momentum around it.
And when you talk about the adoption by your own employees, thinking about how they can drive efficiency, is efficiency what's necessary at the moment when you do have a few well-known headwinds coming up in terms of just costs? I mean, the tax implications that you're getting in Illinois, or what's happening over in New Jersey, for example. I'm also thinking about, Missouri, you're expanding, but that takes a cost up front.
No, you're absolutely right. I think that being able to self-fund some of these things through efficiency gains with AI has been a big driver of our focus. Also, I think there's other parts of the, cost structure that we found that we have value that can be achieved too. So really, it's always a balance for us. We're obviously very much in growth mode now. We had 37% year-over-year revenue growth, but we also are constantly looking at how we can be more efficient, and we view the two as very linked. Oftentimes, when you do things that are more efficient, it frees up better time to be spent on, better things for the customer as well.
So I go back to the expansion potentially into prediction markets. I mean, I know it's about federal regulation in many ways, Jason, but what gets you there? What gets you tipping your toe into it?
Oh, I don't know that we are going to. We're still evaluating our options. Obviously, it's brand new, and we're watching it unfold right before our eyes, and we're learning a lot as we get educated on the space. So right now, that's been our focus, and we'll see what happens from there.
You have but one sell rating, Morningstar. What would you say to analysts over at Morningstar that convinces them to say, look, at the moment, our price point is where it should be? Actually, I'm looking up the wrong one there, so let me go to my proper DraftKings analyst recommendations. Sorry, live interaction with the terminal right now. I have analyst recommendations, 0 sell ratings, but you have 5 buys. What
there you go.
5
Even
holds.
better.
What gets your 5 holds to a buy rating, Jason?
I think just continuing to prove ourselves, performing over time is what gives people confidence in a company. And we've been public 5 years now, so we have a bit of a track record. But we're still a relatively new public company, and we've only been profitable for the last year or so. So I think really showing that we can now grow our bottom line while continuing to post impressive top line numbers, that's our focus, and I think that'll get more people on board.
32 buys, 5 holds, 0 sells. Jason Robbins, DraftKings CEO, we thank you very much indeed.